Right. Good morning, Alexander. I hope you're okay. My name is Zafar Iqbal, and today we'll be looking at the LO3 and your assignment as well. Okay. So it's a topic for level 7.
Hello.
Hello, good morning,
Hello.
sir. You're okay?
Yes, are you okay?
Fine. Thank you for joining. I was just saying introduction. Good morning.
Yes, thank you. I'm listening.
Okay. Good morning, Alexander. You're okay?
Yes, hello.
And I am Zafar Iqbal. Nice to have you on board.
Yes, let's do it. Thank you.
Okay, we'll be looking at LO3 and assignment discussion today, okay?
Yes, okay.
Okay, so we might have a little bit extended lesson. Are you okay with this?
I guess, yes. If I need maybe I need to go in an hour and a half.
No problem. Don't worry. We'll try and finish it in time. But if I get over the time, I do apologize. So because we've got a bit more to cover.
Okay, no problem. I'm listening. Thank
Okay.
you.
So what we'll be looking today is we're going to be looking at the LO3. I think that last time we met, we covered the LO1 and LO2. And then you had a birthday party and then we missed each other. So we're going to reconvene on LO3.
Okay.
So LO1 was basically, we looked at financial data, importance of financial data, and the second LO2 was ratio analysis and importance of comparisons, looking at different organizations and comparing them with ratios. Okay, like liquidity ratio and financial ratios and
Right.
capital asset ratio, or so a financial position of the company. This is what we discussed last time. So today's session is basically on the investment decision, the capital expenditure. Okay. And so what we mean by investment decision and capital expenditure, it means long-term investment decision by a company in their organization. So this is very important for companies to make the decision when they want to invest in particular projects. Okay, and we'll be looking at the type of expenditure. For example, you need to be able to cover different types of expenditure like capital expenditure and revenue expenditure. Now, capital expenditure is when where we invest money in long-term projects, and the revenue expenditure is like repairs, the maintenance on these projects or running costs of these projects. So you need to be able to distinguish.
Right. Okay.
So you should be able to distinguish between capital expenditure and revenue expenditure. So capital expenditure, like buying a building, and once you bought that building, you need to run that building. So the running of the building is known as the revenue expenditure. Okay. So this is what we're looking at. You need to be able to look at the investment techniques, payback methods, and accounting rate of return, net present value, internal rate of returns. These are discounted, cash flow methods. So these are the types of investment appraisal technique that you should have some knowledge of. Then we'll be looking at long-term finance, long-term and short-term finance, the definition of long-term and short-term finance. How can you acquire these finances, and what's the benefit and disadvantages of these external and internal sources of finance? And the last of these today's section will be on the cash flow management, forecast management or forecasting statements, and the benefits of budgetary control and budgets and variances, and how we can control these budgets. Okay, so these are some of the topics that you should know in LO3, because this is all concerned with investment decisions, capital expenditure, budgeting. Okay, and then we will look at your assignment on LO4. Okay, so this is the plan for today. So let's look at 3.1. For example, the methods for appraising strategic capital expenditure projects and strategic direction. What it means that the company's going to spend money on buying assets, and some of those will be buying non-current assets. Okay, as we said earlier on, so the buying of the current assets, buying of fixed assets for the long-term use is known as the capital expenditure or capital investments. Okay, and running of those expenses, running of those buildings, running of those projects is known as the revenue expenditure. So, for example, if you want to invest in a long-term project like a building, a company wants to buy a building, that's known as a capital expenditure. If they want to buy new machinery, if they want to buy a new a new piece of land, okay, this is known as the capital expenditure. And running, okay, running that machinery, for example, oil, for example, repairs, for example, personal wages of that machinery is known as the running expenses, as it is known as the revenue expenditure. Okay, repairing machinery, repairing a building, painting, for example, cleaning wages, right? People who work in that building, or this is known as the revenue expenditure.
Right.
You are buying a land, okay, this is a capital expenditure, and people who work on the land, for example, cleaning it, for example, making it good for agricultural products, making it nice for farming, that is known as the revenue expenditure. Do you get this?
Yes.
Okay, so this is very important, capital expenditure and revenue expenditure. And then we want to know the different methods of investment capital expenditure, right? Now, there are different methods of capital expenditure. These are, number one, for example, payback method. Okay, one of those methods is payback. Okay, what it means is how long this project will take you to recover the initial amount of investment. Okay, so how much?
So it's the return rate for the current project.
No, this is payback is just the amount of period it will take you to recover your initial investment.
Okay, the amount of time.
It's just a time. Okay.
Okay.
So, for example, if you bought a building for £100,000, for example, and it will take you 3 years or 4 years to recover your initial investment time, investment money. This is the time period. This is the payback method. This is the payback period. It will take you to recover your initial investment. After that, whatever you get, it's your profit. Okay.
Okay.
So this is very simple. Very simple. Simplest of the technique is known as the payback method, i.e., you need to know how long it will take you to recover your initial investment. That's all. Okay. I.e., the shortest period you will recover your money. Advantage of this method, payback method, is very easy to calculate, very easy to understand, and it takes the timing of the cash flow. It's very useful for people to calculate how many years or what time period they need to recover their investment very quickly. It's simple. There's not much calculation. Disadvantages. Yeah, disadvantages, it doesn't take time factor into account. It doesn't take interest rates into account. It doesn't take profitability into account. It doesn't take any returns. It just simply assumes that this will, how much time will take to recover the initial investment, and that's all. It ignores revenue and costs. Okay.
Right.
So this is the disadvantage. But the main advantage is very easy to calculate. Example is like here, payback period. For example, if you got a year 1, 2, 3, 4, and 5, and you initially invested 3,100. Yeah, you invested 3,100 in a project. over the years, year number 1, year number 2, year number 3, year number 4, and year number 5. So, for example, if you get 1,000 in year 1, you get the cash inflow. Second year, you get 900, and third year, you get 800. Fourth year, you get 500, and fifth year, you get 500. How long it will take you to recover this amount of money, which is 3,100? You can simply see from this data that it will take you about 3 years plus, okay, less than 4 years, over 3 years. Between 3 and 4 years, you will recover your money.
Okay.
How do you know? Because you calculate 3,100, right? That's the investment you made. Okay, in first year 1,000, in second year 900, and in third year is 800, right? So this is, if you calculate this, that will be 3 years and something. How do we know? Okay, so 3,100 minus 1,000 will give you 2,100. So that's the first year you will recover. Okay, so second year you will get 900. So you added 2,100 minus 900 will remain you 1,200 pounds. The third year you will get 800. So you 1,200 minus the 800 will give you 400. So that's how much it left you to recover.
Right.
Now 400 next year, in the fifth year, you are getting 500. Now 400 pound is left for you to recover, but you're getting 500. So that means 100 pound, you're getting more than you should have got. Okay.
Right.
Now, okay. So this between year 3 and year 4, you are turning from negative to a positive. Okay?
All right.
So your positive inflow is 100. Yeah, your positive inflow is 100 and your negative is 400. So the difference is 100. So this is, you need to know how many years you will need to recover this project money. So it will lie between 300 and 3 years and 4 years. So you need to, what you need to do is you need to calculate 400, which is the cumulative cash flow, divided by 500, which is the positive, multiplied by 12, which is the year, right? You will get a factor of 12 multiplied by 8, which is you get a 10 months. So you get it? So it's 400. Yes. Okay, 400 divided by 500 multiplied by 12, which is a year, 12 years.
Yeah, 12 months.
12 months. So it will 12 multiplied by 8, which is 9.6, or around it about 10, right? So in the month 10, you will recover all your money, and then from then onwards, you will be positive.
Right.
Okay. So how long, if you were asked how long it will take you to recover, so it will be 3 years and about 10 months.
Okay. This
is the payback method. This is very simple, very straightforward, and you can calculate that. So your initial investment, which is 3,100, will be recovered in 3 years and 10 months. And after that, you will get profits all the time. Okay. The disadvantage is that it doesn't take any interest into account. It doesn't take any time period into account. It doesn't consider any other timings. So this is a quick, simple method. Okay. Superseded by this method is known as the discounted cash flow method, or net present value method. Okay. Now this discounted cash flow method involves the net present value, i.e. how much your project is in current value. Current value is multiplies by your discounting factors. Okay. So the discounted cash flow, it discounts your cash flow in terms of today's money. Future money converted into today's money. Okay. So suppose you are going to receive £1 next year. How much is it worth today? Okay.
Right.
This is what the discounted cash flow, or net present value, it takes this into account. It measures the wealth now as a result of accepting a project. Okay. So if the net present value, how do we know this method is good or bad? we can judge by three factors. If the value of the net present value is 0, then we will either take it or just leave it, okay? Because it doesn't give us a positive or negative return, okay? So we don't have to take it. We will decide whether it's worth taking or just leaving and looking at something else. If it gives you a positive figure, then we will go ahead and invest in a particular project. And if it's a negative, then we will not go ahead with it. And if it's 0, then we are either way, okay, neutral. Yeah. So if it's a positive,
right,
the figure is a positive, then we take it. If the figure is negative, we leave it. If the figure is 0, we are neutral. We don't have to take it. We don't have to leave it. It depends on your own decision.
Okay.
How does it work? How does it work? It works on the fact that net present value is discounted, and it considers the future value of time. Consider the time value of money in future, and it takes the amount of timing and the amount of cash into consideration when making a decision. That's the advantage of net present value. The main disadvantage is sometimes it's difficult to understand. Sometimes you have to consider calculations, and people don't like calculations, and makes a life difficult for them, okay? And then you need to find out some kind of a discounted rate. It's an arbitrary figure. It's a fictitious figure. It just picked up from the air, depending on the historical data or your anticipated return. Yeah. So there is not exact, you are not working exact figure, but you are just playing with the figure. Suppose, the inflation rate is 5%, maybe next year it's going to go up a little bit, 7%, or maybe it's going to go to 6%. So your figure is hypothetical figure, okay? Arbitrary figure.
Yeah.
So, yes, so you're working on the forecast, in other words, your future.
Yes.
Okay, so it's not exact, but it is good enough. Okay, so this is the net present value. Example, here is one example. For example, you are investing in a project which cost you 20,000 in year 0, which is today. Next year is known as the year 1, and the year 2 afterwards, and the year 3 even afterwards. So for the 3 consecutive years, we receive 5,000 in year 1, 7,000 in year 2, 3,000 in year 3. So that's your cash outflow. A minus figure 20,000, it shows you the cash outflow, initial investment. Okay, this is how much you spent. This is how much you spent out of your pocket or out of your budget or out of your money. Okay, so minus, this is why we shown. So if you calculate the cash inflow, which is 5 plus 7, which is 12, plus 8 is 20,000. Okay, so you're getting in 3 years, over 3 years, you're getting 20,000. And in the year 0, we've spent 20,000. What we want to know is how much is this project worth in today's terms. Okay, so then what you do is you get a present value factor. Today's money is, we are giving a factor of 1, because as it now stands, we are getting the 100% value of 20,000. So this is what we've spent. This is how much.
Okay, so that depends on the inflation and the different other instruments, regulatories, and the things on the market.
Correct. So the 20,000 we've spent today, we multiply by a factor of 1, which is 20,000. Okay. Next year, maybe some kind of inflation, maybe some kind of, as you say, some kind of other things have gone expensive. So the value of money next year falls down, doesn't it?
Yes.
And the year after, it falls even further, and the following year, the value of the pound or value of the currency falls even further because of inflation, because of the expense, things have gone up because of the material costs have gone up. So the current value of money has gone down, down, down. So you multiply these factors, which is 9.909 multiplied by 5 will give you 4545 next year. Following year is you multiply 0.826 by 7,000. That the value of 7,000 falls down to 5,782. Okay. Now the third year we are multiplying the factor by 0.751 multiplied by 8,000. So 8,000 times 0.75 will give us 6,008. Okay, in today's value, right? So you add these three up. 5 plus 4 plus 6, which is 11.
I don't actually get the 20,000 cash back.
You won't get
the investments.
Yeah, so you won't get 20,000 money back, because in today's money, the 5,000 in a year's time, 5,000 is worth 4,500 in today's money. Okay, 7,000 in year 2 or after 2 years. To 7,000 will have today's value is only £5,700, and 8,000 in year 3 or 3 years time, the £8,000 is only worth 6,000 in today's money. Okay.
Yeah. So the problem not only is the different cash flow. I mean the factor of time and different outcomes, but that further you go, lesser you gain.
Yes, the further time period we are anticipating cash flow, in today's money we are getting less and less.
Okay.
Or money is because of the inflation, because of the cost of living, because of the cost of materials, because of the things have gone up. As you can see from COVID, last year the things were a little bit expensive. Today they have gone expensive, but the value of the pound or value of the currency has fallen down, and the things have gone expensive because of that.
So it's even more expensive. So
it's more expensive.
Doubles or triples, or it goes up. Okay.
So the net present value, it takes the future cash value into account and accounts for today's value. Okay, in terms of today. So this is very important when we are taking the investment decision. Another technique is the accounting rate of return. We can use the accounting rate of return when we are investing. Now, the accounting rate of return is the amount of average profit to initial capital employed, i.e. accounting rate of return or the average rate of return divided by the initial capital is multiplied by 100 to give you an exact percentage. Now, how it works is like this. The third example. So if these are the 3 projects, A, B, and C, which is Andover, Bristol, and Carlisle, right? And then if you are investing in year 0, you are investing £4 million in Andover, in £4 million in B, which is Bristol, and £5 million in Carlisle, right? What is this average return, average rate of return over the years? Now, if you look at 1, 2, 3, 4, and 5 year, how it works is you add these profits up, okay, every year, and then divide it by the number of years. You will get an average profit. So in year 1, you're getting £1 million. In year 2, you're getting £1 million for this Andover. Year 3, you're getting 1 million. So every year you're getting £1 million. So over 5 years, you're going to get £5 million, right? Divided by divided by number of years, which is 5. So every year you'll get 1, right? So the average becomes 1, multiplied by the average, multiplied by the percentage, okay, initial capital, which is 4, right? You will get a 5% return. Okay.
Yeah, so basically I get the average profit for the whole period of time, i.e. 5 years. then I divide it by the amount of years, so 5, and then I multiply it by 100. So I get the percentage.
Yes,
Right.
so you get the percentage, you add the total profits, which is 5, divided by number of years, which is 5, that's 1, multiplied by the initial capital, which is 100%, which is the initial capital is 4, so you'll get a factor of 5%.
Okay.
Okay. If you look at this, you compare this project with the C, Carlisle, right? The Carlisle factor is the initial investment was 5, but you got nothing in year 1, and you got 0.5 million in year 2, 1.5 million in year 3 and 4 and 5. So your total profit will be how much? 3 plus 2 plus 1.5 plus 0.5, that will be 7. 3 plus 2 is 5 plus 2 is 7, right? Okay.
Yeah.
So 7 minus 5, which will give you the 2. This one here. Okay. So your total profit will be 2. Now 2 divided by 5, which is the number of years, will give you a 0.4, which is 0.4 multiplied by the initial investment, which is the 5 multiplied by 100%, which will give you the 8% return. Okay. 5 divided by 5 minus 7 minus 5, which will give you the 2, which is the average profit, divided by your initial capital, which is 5, multiplied by 100%, which will give you the 8%. Okay. So if you can multiply that you can check it out. 2, okay, over 5 multiplied by 100 is 8%.
Okay.
Yeah. So this is the average rate of return. So we looked at the payback method, number 1, which is very simple. We looked at the discounted cash flow, which takes into account the future value of cash in present value. This multiplied by the present factor. Okay. Third one is we looked at the average accounting rate of return, and that takes into account. And this is an activity that you can calculate when you have the time, please. Yeah.
Okay.
Calculate. Okay. When you have the time, you can calculate this. It looks at the exact payback period. Very simple. Okay. Comparing 2 projects, A and B, over the 5 years. Initial investment, both of these is 10,000. Okay. Then you get this value of these projects. You get 3 over 5 years, 3,500 over 5 years. And this project B will give you 6,000, 4,000, and 500.
Yes, so it's going to be like 3 years and 2 months.
Yes. Okay. Whatever is the whichever takes lesser, this is the amount of, this is the project that you go for.
Okay.
Okay. The shortest period that will recover your costs, we'll go for it. What factors will you consider when looking at the payback method, i.e. the time factor or the amount of money that's giving you a quick return? You will invest in that particular project. Okay.
Yeah.
Okay. Here the accounting rate of return, the second exercise, determine which project for 3 years you should be pursued under the ARR. So you look at these 3 projects and you tell us which one you're going to go for. So you can compare them and you can work out your ARR using this formula. Okay, this formula here.
Right, right.
Okay. So that's your activity. That's number 2 activity. Okay. So yes. So going under what circumstances might a company choose a project with a rapid payback rather than one? We've said high rate of return and quick method, and then we move on to the next bit, budgetary control, or okay.
Yes, yes.
Okay. Now we will look at the budgetary control in the 3rd section. Now we're going to look at the 3.2, i.e. the investment proposal or the capital expenditure using appropriate financial techniques. We've looked at the techniques that we were ARR and what you call them, payback method, and we've looked at the discounted cash flow. Now this section looks at the sources of finance, I think, isn't it? And what's the strategy and what's the objective of investment and investing, and looking at the budgets as well. So we need to look at the budgets. What is a budget? What type of budgets are there? How we prepare these budgets and the objectives of these budgets. Now, do you know anything about the budgets?
Well, only the word, I mean, only the term. Yeah.
Okay. When we are looking at the budgets, what we mean by budgets is kind of a planning exercise, okay? Future targets, for example, or what's the word, how much are we going to get income and how much are we going to spend, and what's the amount of money that we have left for our own purposes. When we are looking at a budget, we are preparing a plan for future. For example, if we are working as a salaried person, or if we are working as a businessman, or if we want to invest in particular projects, of course, we need to prepare budgets as to how much we're going to get income and where we're going to spend. Okay, and this is the plan. This is the planning. Okay, the effect of this is the planning works according to our project, according to our objective, according to our strategy, according to our plan. What are we going to do with our budget? Why do we need budgets? Okay, we need budgets for future planning. We need budget because the circumstances will change in the future, and we want to make sure that we have enough sources of finance. We have enough money to allocate resources for expansion, for example, moving over to new projects, doing something new, right? So yeah. So for all sorts of purposes, a country has a budget. For example, future planning, how much it's going to spend, where it's going to get the revenue from, where it's going to spend. Is going to spend money on education, or is going to spend money on hospitals or roads and defense and so on. So how much imports and how much exports, where is going to get the money from, borrowings or wherever. All this is part of the planning exercise. All this is to do with budgets. Okay, and we've got to control our budgets. Of course, we have to have a good planning techniques for preparing budgets. Now, budgets is a very important planning technique, planning tool to look at the future, in other words. And there are different budgets. There are different types of budgets in organizations. And we want to make sure that our budgets is on targets. Sometimes budgets works on targets. Sometimes they go over. Sometimes they go under. Okay. And we've got to make sure that there are techniques, there are tools in place. Why has it gone over our expectations, or why has it underperformed?
Right.
Performance, okay, which we have compared to, are we going, are we going to according to plan, or we are not going to according to plan? Why is there a problem? Why is there issues? And therefore, we want to make sure that the budgets are taking place in organizations or in anywhere. So they are working on to plan actual budgets. And then if they are going according to plan, that's fine. And then we can check, we can monitor, we can evaluate, and we can put them into a better places. If they are not working, then we need to do something about it. Okay. So the budget is a planning, and there are tools and techniques that we want to monitor and check our budgets are going over and under. Okay. And this is known as the performance against the budgets. The different budgets known as, there are many budgets, many types of budgets. Sometimes are known as long-term budgets and the short-term budgets and the current budgets. and flexible budgets and fixed budgets. Okay. According to functions, there can be sales budgets, there can be annual budgets. In a country, for example, when we have annual budgets, that means a yearly long-term budgets or short-term budgets, right? In an organization, we can have production budgets, we can have sales budgets, we can have capital expenditure budgets, master budgets, right? And according to flexibility, as I said, it's a fixed budget, and sometimes they are flexible budgets. So there are different types of budgets, and what we many different types of budgets, and we've got to make sure that these budgets, there's some people who looks after these budgets, and people who prepare these budgets are mainly people who are responsible for financial analysis, i.e. accountants and financial managers like yourself. So you have to be able to prepare budgets, okay? And this is an important function because the organization relies on these budgets, because finances is the most important backbone of the organization. And it look at the long-term investment, it looks at the short-term investment, it looks at the cash coming in, it looks at the cash going out, where you're going to spend. So the cash budget, one of those budgets is the cash budget, okay? Now, cash means how much money is going to come in, receipts, in terms of cash. Yeah? What's your money in cash terms? What's your payments, i.e., yeah? What's the balance left? So this is what it is. Cash budget is how much you have left, how much you have in the bank, how much you have in the cash, how much you're going to spend, cash mean, right? So cash budget is very important. And this is why we need cash budget is, of course, you need to have cash budgets for, buying goods and selling goods and paying wages, paying salaries, paying bills, paying workers, all, if you don't have cash, then company, of course, naturally cannot run. Do you agree?
Yes, yes.
So the cash is very important. Now, the cash is known as a working capital, and working capital is the day-to-day money management of the business, i.e., somebody needs materials, you have to pay for it, and somebody has to be paid wages, and if you don't have wages payments, then you have a problem, okay? And this is very important. So you have to have a cash budget, okay? Now, one example of the cash budget is this one here. Can you see this? Brown and Co. has prepared the following forecast for 6 months ending 31, 12, and 16. So they have prepared a cash budget or cash forecast for this particular company for the next few months. So they have sales, they have purchases, they have wages, they have salaries, and they have sundry expenses. Now, sundry expenses are expenses, miscellaneous expenses or other expenses, or things that don't go into any type of heading. Sundry expenses, okay? They have July, August, September, October, November, and December. So these amounts in July to December, they have got these sales, and from July to December, these got purchases and wages and salaries and sundries. Now it says here, required, prepare a cash budget for 3 months, ending 31/12, and comment on the position of the company. And so it says, we need to prepare a cash budget for 3 months, which is 31/12/16. So 31/12/16, but you have got the forecast, you have got the figures for last 6 months, July to December. But we only required to prepare our cash budget up till 12, which is December. So we will start looking from October, November, and December. Okay?
Right.
But the previous July, August, September, the sales and the purchases will roll over. Okay, will roll over from those months into October, because some people will pay late, some people will get money late, some people.
Right.
Okay? So we will begin to receive and pay from October. Okay. Yeah.
Right.
Okay, so this is the solution here, cash budgeting for the period. So we write July, August, September. We don't do anything with it. we begin from October, November, and December. Okay, and we begin with this type of layout. We have a receipts and we have payments. Receipts mean money coming in, and payments means money going out.
Okay.
Okay, and then how the receipts, we have opening balance. We always have some kind of opening balance, i.e. the balance that we started with. So in this month, October, it tells you here, notes, the cash balance at October will be £15,000. Okay?
Right.
So that's the opening balance. That's the opening cash. So when we prepare a cash budget, we prepare the cash budget with an opening balance of 15,000 starting from October. Okay?
Right, right.
How much do we receive in October is £46,500. Okay? Now, how do we work this out? You need to look at the notes, Alexander, okay? You need to look at the notes and read the notes. So the cash balance is 15,000. So you begin with October the 1st, 15,000. Then cash note number 2, it says 50% of debtors pay at the end of the first month and 50% of the debtors pay at the end of 2 months. Okay, month
Right.
2. So some of these people here will pay us first month, and some of them will pay end of 2 months. So we will have money coming in the first and the second month. So the sales, if you look at the sales here, £52,000 if sold in July will pay us in, what's this? Half of this money will come into this month,
right,
end of the first month, and then half of the money will come into August. Okay.
Okay, so it's delayed.
It's delayed.
50% of it is delayed.
So you have to work out how much how much will we get. Okay, so you have to have a workings somewhere, and you calculate how much you're going to get, and the total that you will get in October will be 46,500 because you have some workings somewhere. You have to calculate all these, and the total money that you will be having in October will be 46,500 plus 15,000 will give you the total receipts of 61,500. Just take my word for it, because you have to calculate and struggle a little bit.
It's right. It's right.
Okay. Then you carry on with the November and December. So your sales will roll over, and the money will come into the second month and the third month. Okay.
Yes.
So in November you will get 47,000 plus 20,000. So that will be 67,025. In December, you will be in a minus figure, because here I think we'll need to look at this cash budget down under here, for example. Okay, this is how we will get. So 15,000, 46,000 is 61,500. Your expenditure or your payments will be 28,000, and then wages and the salaries and the sundries and equipments. All this one amounts to 41,475. So your total receipts, which is 61,500 minus 41,400, will give you the closing balance of 20,000 to 20,025 pounds. Okay.
Okay.
This will be used to be opening balance for November. Then you get these receipts. You add these two together, that will be 67,025. Then you take your payments out, which will be 78,068. So your payments has gone more because you bought some equipment this month in November. Because if you look at this here, new equipment ending 35,000, costing 35,000 will be paid for in November. So the cash budget will be gone over in November. But your revenue is coming slowly, 2 months delayed. So this will be giving you 11,655 minus value. Okay, you begin this minus value is 11,650. Receipts are 50,000. So your total net receipts will be 50,000 minus 11, which will give you 38,800. your total payments are 41,310. Still, you are short of 2,465 minus figure. Okay, so the whole thing is minus. In December, you are into debt, minus 2,465. Okay, that's your cash budget, minus cash.
Right.
Okay? And this is the calculations that you have to do in order to calculate your cash coming in. Okay, calculation by sales and calculation by purchases. This is the workings have been shown for you. Okay.
Okay.
Now we want to know why this minus 2,465 has gone overdrawn, or why are we short of the cash. This is where the budgets comes in. Okay, and this is the purpose of planning, and we want to know how we can cater for this. Now the sources of finance. Okay, so the minus figure has gone up. We want to know where we have gone wrong, what's the problem. And this is the cash budget, and we want to know where we can get the sources of finance. And this leads us to know there are different sources of finance in a company can have. A company can have different sources of finance depending on how much they need, depending on how much they're going to invest, how long they're going to invest. Okay, why do they need this? Because they have so there are different factors to consider. How much you need, why do you need it, where you're going to spend, why have you gone over the budget, why have you gone bad in planning, all sorts of reasons, right? So you should have taken that into account, and the budgets is important. Now different sources of finance, because you can have this minus figure can be recovered from your own sources of finance, or you can get money from outside the finance, outside your finances. Okay, the one that you can recover from your own pocket, from your own internal sources, are known as the internal sources of finance. And the one that you cannot recover from your own pocket, or from your own savings, or from your own investments, or from your own deposits, are known as the external finances. Okay.
Okay.
The internal finances are cheaper. The internal finances are quicker. They are your own savings. They are your own money that you can take. Okay. By, for example, you can get some, you might have, the company might have some saving. They might have kept some profits. They might have some stock they can get rid of to collect the money, or they can get some assets, they can sell it, or they call their debtors to pay them quickly rather than delaying 2 months or 3 months because we are in problems. We need to ask them to pay our money back. Okay, so these are known as the internal sources. Or you can go outside, you can get a bank loan, or you can issue what you call the share issues. You can lease money. You can ask the government banks to give you a loan or credit, or what you call them overdraft, or ask your creditors to give you longer time to pay them. Okay, so these are the external sources of finance. Some of these external sources of finance are short term. Some of them will be long term. Now, for example, mortgage is a very long term. Hire purchase is a medium to long term. Leasing is also a medium to long term. Okay, it depends. And short term is bank loan and overdraft. So these are depending on what you need, how much you need, how much the cost of this finances. It is a source of finance that you can go for. Okay, so this money minus 2,450, which is the 2,465, is your cash. You can go for internal sources, or you can ask for external sources of funding. Okay, depending on your needs and your requirements and your costs and your budget and so on. There are many factors. Okay,
right.
So when you look at these finances, you need to be able to sort these factors into account as to what you need, how much you need, why do you need, the cost of loans, and do you need them? So there are different types of finances for different types of purposes. Okay. For example, share capital. Why do you need share capital? Why do you need business angels? Why do you need mortgage? Why do you need a leasing? So you need to look at these and the factors considering. Okay. Long term, yeah. When you are deciding for going external, the main thing is the cost of factors, the cost of the borrowing, the cost of money. The longer, the more money that you need, they're going to be expensive, and the shorter money that you need is going to be difficult as well. So you need to look at these both. Okay, so sources, external and important external sources of. So this wants you to make sure that you manage your cash flow very importantly, very quickly, and very vigilantly. Okay, so once you write these sources of finance, internal and external, for the funding for the organization, you will be able to see what you need. And up to that, it's a pass criteria. Okay, sources of finance, the longer term and the shorter term, the reasons. If you want to claim, go for a merit, then you need to look at the management of the cash flow, the nature, the purpose, the decision, your own what you call them, your own judgment. Why do they need it? When do they need it? And what's the reasons for their? What do you recommend them to do? Okay, the purpose. So the decisions are, depends on your long term, your short term, your cost of finance, your allocation of dividends, i.e., how you're going to manage, how you're going to pay your investors, and what considerations you're going to take into account when you are going to satisfy your stakeholders. All right. So when you take decisions, you have to do these things. So investment decisions is very important in the sense that, the cost, okay, the cost, the short-term period, the long-term period, and the type of projects that you're going to delve in. And the longer term is the consideration upon your stakeholders, okay? So this is, your own decisions, okay? And what do you recommend them to do? What do you recommend your company to do? For example, do you ask them to invest in this particular project, and where they're going to get the money from? How much is it going to cost them? And why do they need this long-term money? Where are they going to get internal sources or external? Are they going to issue new finances? Are they going to issue new dividend? Are they going to go public? Are they going to go private? All sorts of recommendations. Okay, so this depends. Example here, if you look at this, for example, this particular NHS, okay, right, you can look at their budget, and you can look at their outlay, and then you can read them, you can see what they want to do, and you can recommend what they should do and what they shouldn't do. So all these, it depends on their investment and their reading, and you need to look at their in what you call them accounts to propose what they should do, what they shouldn't do. Okay, so you can look at this accaglobal.com and go and see what kind of things that the NHS would investment in and why, and based on that you can make your decisions on that. Okay, you can look at the Highland Council, you can do a BG group. So there are different case studies you can look, and you can see what type of they are making decisions and why. And okay, so there are 3 examples, you can look at them. Okay, yeah. Another one, you can look at Marks and Spencer's case study as well. Okay,
I get it.
Right, there are references, you can look at the different references as well. Okay, now I want to go on to so what we've done today is we looked at the investment decisions today. Okay,
right.
we've looked at different methods. In other words, let's summarize. We've looked at methods. We looked at payback. We looked at the internal rate of return or average rate of return. We looked at the sources of finance. We looked at the internal sources and external sources of finance. We said we going to invest in projects that are taking they take less and give us good return. We looked at budgets. We looked at budgeting. We looked at cash budgets, and we looked at different types of budget. For example, cash budgets and flexible budget, or and we looked briefly. We looked at the sales budget, for example, or the different types of budget, flexible budget and fixed term budget. But you need to go deeper into. You do your own research on these. We can only give you a kind of bones, and you have to put meat on the bones, as they say.
Yes. Yes.
Okay. So this is enough material for you to be going on with as far as the study is concerned. Okay. And you need to look at the ratio analysis to compare companies. So, when we have, so let's, so this is what the done today. So let's look at your assignment, Alexander. Yeah.
Right.
I want to look at this assignment here. Can you see this?
I'm seeing the average profits per year, so the ARR ratio.
Okay, let's look at this new share. I'm going to share this screen with you here. I think this one, discussion on brief assignment.
Yes.
Okay, now this is your assignment. There are 3 or 4 tasks in your assignment that you need to be able to do. Okay, I'm sure I don't need to go through the command verbs. You're very familiar with these. Okay, task 1, there are 4 tasks on this assignment. Now the first task is it says financial data and strategic decision making, where you need to produce a presentation, i.e. a PowerPoint presentation for your next meeting with the Chamber of Commerce. Okay, you look at your presentation in terms of evaluating sources of financial data that can be used to inform business strategy. Okay, you should include some kind of financial data, risk related to financial data, and methods that can be used for appraising strategic capital expenditure projects and strategic decisions. What it wants you to do is you need to prepare a presentation whereby it says sources of financial data to inform business, i.e. sources of finance. Okay.
Yes.
Sources of finance. Why do you need these sources of finance? Internal and external sources of finance, and the type of decisions, the type of investment methods that are important for projects. So you need to describe some kind of investment projects in payback and internal rate of return and discounted cash flow and so on. Okay, so this is on your task number 1.
Right.
Yeah. Okay, and this one here is your financial data will be on this one here. You look at them and you read this. Okay, you look at them, you see what the data is about.
Yes.
Second task is you look at this using those these ones here, financial balance sheet maybe, or profit loss account or whatever. You use this financial data to do task number 2 as well. Okay, now this says a ratio analysis. Okay, you want to compare analysis of financial data, i.e. you use the ratio analysis. We looked at the ratio analysis like liquidity ratio and profitability ratio, financial ratio. So you take
We've
that.
been talking about it the last time.
Yes, so we looked at, so you compare these 1 or 2 organizations, right? Here, These are the two organizations that you can compare, or you can select your own company and another company, and compare both datas and see which company is better, which company you're going to recommend. Okay. Okay, so this is the second task, is your ratio analysis. You're using those ratio analysis. Okay.
So it's a presentation too. So I mean, what kind of format is for that part of the assignment?
This is just what you call it, comparing. You take the balance sheet, you take the profit loss account, and you calculate those ratios in a table format. Okay, maybe
it's table format. Okay.
Yes, table format, and compare using those analysis, using the ratios that you can. So for example, if you're comparing company A with company B, yeah.
Yes.
Put them into columns, company A, and put them column company B, company A and company B, and you on the left hand side you say current asset ratio. Now, then you need to define a current asset ratio, means current asset divided by the current liabilities, right? Multiply by 100, or if you don't not multiply by 100, you put that into a ratio of 1 to 1. Okay, which is ratio, right? So current assets over current liabilities for company A, current assets, current liabilities for company B, and then you see which company has good assets, which company has bad assets, and you compare them and comment on them. So I will go for company A because it has a good current asset ratio. It can meet its current liability. It's a good company because it's good. It's doing good in budgets. You know, some kind of comments, please. Okay.
Yes. Okay.
So this is task number 2. It says here, you know, an interpretation of financial statement. So financial statement is looking at a profit loss account and balance sheet.
Right.
Okay. So you compare them, and the comparative analysis using ratio analysis. So you calculate those ratio analysis and you tell us what you found out about which company is good, which company is bad. Because you're, if you are a manager, you need to compare your company with another company. So you need to, and you compare it by ratios, you compare it by financial data. You look at so people who want to invest, they want to know which company shall I invest in, and you tell them. Task number 3, it says here, it says information leaflet, i.e. you tell us information leaflet, i.e. information about creative accounting. What is creative accounting? What do you do with you know, what does it mean by creative? How would you polish? How would you look this company as an investment, as an attractive investment? What do you need to show them when making strategic decisions?
Okay.
And what are the problems? What are the issues with your using of ratios? And then the third task is the important cash flow management, i.e. what is cash flow? Why is it important to look at the cash budgets? And why should you manage cash budget? What are the budgets? Yeah, the importance of cash flow management, i.e. the cash budget. How can you make it? How can you satisfy? Yeah,
right.
So you can explain different types of budget, but importantly cash budgets, and you give example of a cash budget. Okay, and this is how you can prepare a cash budget, because cash budget is important. So here there are 3 tasks. Number 1 task is the importance or the impact of creative accounting, right? What is creative accounting? What does it do? Is it good? Is it bad? Advantages, disadvantages, or is it a show off? You know, it's fictitious, or is it real? Yeah, we looked at the creative accounting. Can you remember? I think we looked at in LO1.
We've been through it.
Yeah,
right.
So you know, in other words, you know, you show your accounts to be glossy for other people, so they invest in you. But in fact, your accounting doesn't back that up. You have just, in other words, you are conning people, you are defrauding people, you are asking them to invest in your company, which is good, but actually it's not good. It's not strong. Okay, it's not worth investing money in, but you are pretending it's very nice investment and it's good, right? So this is called creating accounting, frauding, in other words. And you remember of those three people's been, when we discussed that LO in L1, so some people have been in prison for 25 years for misfraud and defrauding investors because of the creative accounting. Yeah. Okay, the ratio analysis, and you compare the cash and flow. So there are three tasks within this particular task, and you can use this kaplan.co.uk financial management, and you can use their creative accounting and go and find out from there. Or there are some things on ratio analysis, and you look at these. Okay, cash flow and ACCA, or you can pick up your ratio analysis from this examples and so on. Task 4 asks you to look at investment appraisals. Investment appraisals like payback method, like an IRR method, like discounted cash flow, right? So what you need to do is you need here, you need to tell us, what are your investment decisions? How are you going to use this? So if you look at task 4, it says capital expenditure appraisal. It gives you a kind of appraisal figure here, the payback method, for example, right? And it gives you some return in machine A and machine B. It compares both of these investment, right? This is particularly to do with payback, and you tell us what you need, the company's cost of capital. It tells you the additional information, and you are asked to prepare a report to evaluate capital expenditure using appropriate financial techniques. So you can use here, you can use ARR, you can use payback, you can use DSF, yes, to tell us which project you're going to invest in and why, and the advantages and disadvantages, and how much you're going to get return, and so on. Okay. So this is task number 4. This is quite a little bit difficult sometimes. It'll be, testing your ability.
Yes, but as I get it, the task number 4 is like the whole information that I need to do it is already right here.
Already right here. Everything that you need is already there.
Okay, so it's just accounting and implying those ratios and implying those formulas and
yes,
doing the accounting.
Okay, yes, this is all it is. Because it's because if you look at this module, it says finance for module. So obviously financing is to do with figures, and figures, people don't like figures, and figures is to do with
but it's crucial. It's crucial for the whole diploma. Like the strategic management is partly about the accounting and the budgeting too.
Yeah, so this will be so all these learning criteria have been outlined here. Task 1, it covers you with your learning outcome 1 and learning outcome 3, and the assessment criteria is there. Task number 2, it covers your learning outcome number 2 with assessment criteria 21 and 22 and merit criteria. And task number 3 covers your learning outcome number 1, learning outcome number 2, learning outcome number 3 with merit and distinction. Okay. And the task number 4 covers you with your assessment criteria. Okay. With 3.2 and the distinction criteria. So every task covers your assessment criteria. So you know what you are covering. Okay.
Right.
All the sources that you need are there for you, and you basically use this if you need to use additional sources, of course, you can use your own research, and you use anything that backs your work. Of course, you can use.
Okay.
All right. So, any question or anything that you're not sure, anything that we've missed out?
Well, I guess not. I think that I need to look through the whole ratios and the formulas again. Maybe then I'll get some questions, but I don't think so. Actually, it's not quite simple, but it's fairly simple.
Yes.
I mean, yeah, it's understandable. And I guess that's just, you know, the accounting. So it's basic math and a little bit of time.
A little bit of time, yes, of course. And you know, you can work your way around to budgeting, to cash budgeting, to ratio analysis, to investment analysis. Okay, so good luck with the assignment, and thank you for joining. And it was nice meeting you, of course, and we had a lovely time with us.
Yes, thank you so much. I'll see you again sometime, right?
Yes, and I look forward to your assignment.
Yes, yes.
Of course.
Bye.
Thank you for
Cheers.
joining, and have a good day. And
Yeah, you too.
we will join you with another subject. Okay.
Okay.
Okay. Bye bye.
Bye.
Bye, Alexander. Bye bye.